The following program sponsored by Adams Financial Concepts.
About money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth, and has a proven track record of managing long-term investments surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So we're going to be talking about money today, as we do on each of these programs. You know, the market was down 1,033 today. It's been down 1,000 on Monday. It was down 666 last Friday. I believe it's been down 5 or 6 times out of the last 7 days. So what's going on? I mean, this kind of makes me happy. When you see this happening, you start to wash out the people who are the weak hands. You start to wash out the momentum players. You start to wash out the people who are short-term players. And you get down to the real investors in the market. For long term, it's good to have these shakeouts every once in a while. And what complicates it in these days is if you look at what happened to Boeing a couple days ago, Boeing stock dropped 20 points in a minute. That's not humans selling their stock. That's computer trading. I've done a couple shows on computer trading. We'll probably do another one before this year's over. It's something that we live with, and over half the trades that are made on the exchanges now are done strictly by computer. They respond much faster. They respond instantaneously to news, and they buy and sell, and they sell in small increments. That's a program we'll pick up later on. Chuck Jaffe, a syndicated columnist who does a column for the Seattle Times, wrote a column this last Sunday that said, "Did you pick the right financial advisor?" We're going to talk about that column because I believe a lot of it is really correct. I believe there's a lot of truth to it. And in these days, with the market doing what it's doing, it may be a time for you to examine, did you pick the right financial advisor? My guest today is somebody that's got a very interesting story to tell, a very healthy story to tell. It's something you want to listen to what she has to say too. So 80 years ago, Ben Graham told a story. He actually wrote a book called Security Analysis. It's a book that's still valid today. The investing principles are still valid. It's one of those classic books that investment financial advisors and investment people read. Security Analysis by Ben Graham. It was a classic in 1934, still a classic today. And he tells the story. He told a story about financial advisors and why they act the way they do. And I thought that was appropriate, coming up later in the program. He talked about the story of an oil prospector who dies and goes to heaven. St. Peter meets him at the gate and says, "I'm really sorry. The compound where we put oil people in is completely full. There's no room for you in the compound. There's no way we can squeeze you in." So the oil man thinks for a few minutes and then says to St. Peter, "Can I just say a few words?" St. Peter says, "I don't see anything wrong with that." "Okay, go ahead." So the oil man cups his hands to his face, and as loud as he can yell, he yells, "Oil discovered in hell." And suddenly the gate slams open, and all these people that were in the compound before come rushing out and are headed to that other region. So St. Peter is impressed by this whole thing, says to the guy, "Well, go ahead and go in and make yourself comfortable. It's almost completely empty." And the oil man says to St. Peter, "I don't think I will. I think I'll go where the rest of them went because there could be some truth to the rumor." It seems only so appropriate as I talk about, did you pick the right financial advisor? And as we do this series, we're picking up on this series, what's wrong with financial planning? This is the 4th in a series of actually probably 5. I've got to finish it up, I think, next time. I'm thinking of running out of things that are wrong with financial planning. But I think that there's significant problems with financial planning. During 2008, 2009, there were a lot of people who had depended upon their financial plan who saw everything go awry. Maybe I was born skeptical. Maybe it's because I have my own strategy and philosophy for building investment portfolios. I spent the money once to have the very best financial planning software. I picked the best of the best, the creme de la creme. I wanted to look at something and have something that was very valid. And when I looked at it, there were big, big issues. And that's what this series is about. Even with all those beautiful pie charts and line graphs and a report that was 400 pages long, it wasn't right. And as I looked at that, and thought about it, I thought, that report is like one of the most beautiful sights I've ever seen. Because when I was at Carnegie Mellon getting my MBA, one fall I drove down the Pennsylvania Turnpike, and that is one of the most beautiful sights, to see those leaves turn in a million colors. It's just gorgeous to see. And as I looked at that financial plan that we produced, the only one we ever produced, that had so many different colors and so many pie charts and so many graphs, so many things that were so wonderful. It was really impressive. I really, really liked that report. It's too bad it was so wrong. But that's what this series is about. So this is the fourth in the series, and I want to review what I said in the first three. The first issue is that the forecast is whether you're going to have enough money to meet your financial goals, whether it's retirement, whether it's putting kids through college, whatever it is. And that forecast is based on Monte Carlo simulation. And Monte Carlo simulation is based on that bell-shaped curve, what's called a normal curve, or in mathematical terms, a Cauchy distribution. But it's based on that bell curve. And it assumes that you move the curve where the average is, say, 9%. Then if you go to 1%, that's 8% from the average, then it should have an equal probability of being 8% on the other side. So you should have 17% the same frequency that you have 1%. You should have, if you're down 37% one year, as we were in 2008, you should be up 46% at one time. If you're down 40%, you should be up 50%. You know what? We've never been to those higher numbers. It doesn't work because that curve is wrong. And even with fat-tailed distributions, which is what they've modified that curve to do today, it's still the same issue. If you're down 37%, you should one day be up 46%. If you're down 40%, you should be up 49%. Just doesn't work. That's for forecasting and looking out into the future. That was the first series that I did. The second series was looking backwards, because it depends upon the data you put in. There's that old expression, garbage in, garbage out. The question is, what values do you pick? Because that financial plan is based on averages. It's based on what you think the stock market's going to do in the future. Is it going to be up 8%, as it was from 1928 to 2014? Or is it going to be 12.9, which is where it was from August of 82 to March of 2000? Or is it going to be minus 6.9%, because that's what it was from March of 2000 to March of 2009. It depends upon what numbers you put in. So even looking backwards, there's a problem. What do you use? How do you use that data? Depends upon the year you start with and the year you finish with as to what the average percentage has been. And if you put in the wrong information, if it's garbage in, it's going to be garbage out. And it makes a significant difference. The difference between 8% and 9% over 20 years changes the nest egg by 19%. If you put in $1 million, it grows at 9% to 5.1 million when you're at 9%, but only 4.3% at 8%. So that is a huge issue. The third issue is confusing short-term risk with long-term planning. Financial plans use asset allocation, and it's a mathematical fact. If you take stocks at 9%, bonds at 5%, cash at 1%, and you average those out, you're going to end up with 5%. You're not going to get 9%. You're not going to reduce things. You may, over a short period of time, lessen the risk on a short term, but in the long term, you never reach your financial goals. That's the third issue. The fourth issue is execution of the plan. And it seems like now is a time to really talk about that, because now is a time when, or maybe you just have, taken the time to sit down with your financial advisor and go over your financial plan to see where you are on that plan. What adjustments need to be made, what needs to be sold, what needs to be purchased, what needs to be changed in that plan to get you to your financial goals. You know, I started with big firms, with big broker dealers, and some of the big well-known names. And there we were told, sell the relationship, not the performance. Make people like you. You want people to really like you. It's not how well you do for them. It's how well you really like, how much they like you. And so as you sit down with a financial advisor, very often they'll say, we're sitting on the same side of the table, evaluating the investments.
Did you know the 20-year annualized S&P return was 8.19%, while the 20-year annualized return for the average equity mutual fund investor was just 4.67%? That's a gap of 3.52%. It doesn't sound like much now, but it could mean the difference between retiring in comfort and running out of money. For some seniors, a gap that large could cost them hundreds of thousands of dollars and cut their retirement short. Don't run out of money. Call Mike Adams of Adams Financial Concepts today, 206-903-1019, and learn more about how you can, 1, create wealth for retirement, and 2, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
We're back with more about money. For details on what you hear on today's show, visit adamsfinancialconcepts.com. Now, here again is Mike Adams.
So, True Confessions, welcome back to what we've been talking about. At the end of the last segment, as I was talking, the commercial cut in, you know, we have a headset that we wear, and then we speak into a microphone. And as I've got my headset, there's a volume control on the headset, and I had my volume turned all the way off. I didn't hear the warnings that we were coming up to commercials, so I kept right on talking. I was so infatuated with my voice, I didn't hear what was going on. So anyway, I'll try to stay on key with this whole thing. I was talking about the fourth thing that's wrong with financial planning, and that is the actual execution. Because this is the time when financial advisors sit down with their clients. They say, we're sitting on the same side of the table. We're evaluating what's going on. And so you sit down and you go through the investments. And as you go through the investments, they'll say, this didn't do very well. This did really well. We should replace this thing that didn't do well with something that did do well. And all that makes sense. All that sounds logical. But the reality is, you know, R.W. Baird did a study, and I think it's really relevant because in that study, they looked at all the mutual funds, all the equity mutual funds, over 4,000, and they found that 370 over a 10-year time period had averaged, on the average, not every year, not consistently, but on the average, had achieved at least 1% better than their benchmark during that 10 years. But if you narrow it down and look at it year by year, 100% had at least 1 year when they underperformed. 85% had a period of 3 years when they underperformed. And 25%, a quarter of those funds, underperformed by 5% or more. Some underperformed by as much as 15%. So when you're sitting down with a financial advisor and he says, look at this mutual fund, it's not performing well, we need to replace it. Look at this stock, it's not performing well, we need to replace it. Look at this other one that's done really well last year. We need to put it into the portfolio. And all of that sounds so logical and so normal that you sit down and you do it. But the result is you end up, as part of Dalbar's study on mutual funds, they looked at mutual funds and how mutual fund investors have done. And they found that over the past 30 years, that the average equity mutual fund investor, whether they're doing it on their own or with a financial advisor, have averaged 3.69% per year on the average. And yes, that's going through 2008. But if you just look at the Standard & Poor's 500, the Standard & Poor's during that same 30-year time period was up 11.11. So what does that mean? That means for the average investor, if they started with $100,000, they had $286,000 at the end of 30 years. So they've seen their money triple. That's pretty good, don't you think? No, that's terrible. Because the Standard & Poor's on that same time frame would have taken that $100,000 to $2.1 million, almost 10 times as much. So sitting down and saying, this is underperformed, we need to replace it with something else, falls into that trap of switching out the things which are going to perform better the following year for something that performed well last year and will underperform this year. Bond, it's the same thing. The average bond investor got 0.7% versus 7.6%. Now we're seeing changes in the bond market, and I think that those numbers are going to change as bond prices decrease over the next couple of years, or maybe 10 or 15 years. But if you look at it for the last 30 years, the bond fund investor, 100,000 turned into 122,000. Had they just been in the bond index, it would have been 852,000. Very, very big, significant change. So in the execution of the financial plan of moving things around, that too makes the financial plan unworkable. All those things add up to the point that it's better to have something besides traditional financial planning when you're looking forward to investments. We have one more segment on this whole thing to wrap up, and then I'll maybe do a wrap-up show. Maybe we'll move on to a different subject. Anyway, later in the program, I'm going to come back to this. Did you pick the right financial advisor? This is information, if you've listened to these last 4 programs, it allows you to evaluate your financial advisor. You should be asking the financial advisor these questions. What is the forecast based on? Monte Carlo simulation? You have the answer about that. What is the percentage of forecast or percentage information going in for stocks, for inflation, for bonds, for cash, for commodities, for all the other things they want to put you in and stick you into? What it has been the past performance, and how did you determine that that's the right value to use? I want to ask about asset allocation. Won't asset allocation reduce total return? And then, how do you pick what you're going to do over the long term, and how often do you change? All those things factor into your financial plan and getting you to where you want to go. A lot of people in 2008 and 2009 found out their financial plan didn't work. Retirees had to go back to work. They had to cut back their expenses. They had to make changes in what they were doing. Pre-retirees had to think about working longer, reducing the amount they wanted for retirement. And there were some people that I knew where kids planned to go to a certain college. They had to choose a different college that cost less because their college funds were so severely impacted. It makes sense to do the right thing, to get to the right answer, to get to the right goals, and to know what's going on. Those charts and those plans look so great. I mean, I love looking at them. I love looking at the charts and seeing the graphs and seeing the forecast and seeing the probabilities. I'm a math guy. I like seeing all that. But the reality is, if it's not real, it's not worth what it's printed on. Anyway, that wraps up that. I want to introduce my guest today. She's got a lot to say, so welcome to the program, Michele Mehl of Excy.
Thank you for having me.
So why don't we start with your background?
Sure. First, I will tell you that I think you had me on the show to just stress me out. I'm a middle-aged woman, bootstrapping a hardware company, preparing for, saving for my kid to go to college, and all of this is like, okay, yeah, right? Is that the right financial plan as you're getting older and older and older and, investing in starting a company?
Yeah.
So real quick, Excy, it stands for exercise cycling, so it's EXCY, and we've been around here we started in 2014, bootstrapped all the way through a Kickstarter campaign, successfully hit that. We've been in the market for about 2 years on the retail side.
So before we get to that, let's go back and talk about your background.
Sure. Okay, my background. For 20 plus years, I have worked in marketing, working with technology startups, and had a firm here in Seattle called Buzz Builders for about 14 years prior to starting Excy. And we worked with companies like Zulily, OfferUp, Socrata, White Pages, several very successful companies to kind of, bring them to market in the early stage. And now they've been around for quite some time.
Mm-hmm. And successful companies.
Yes.
Okay, so now let's talk about exercise cycle, Excy.
Excy. So what Excy is, it is a small, portable, lightweight, compact exercise bike that you can take anywhere. And the idea is just to be able to safely cycle yourself strong anywhere, whether upper body or lower body, and whether you're battling injury, disease, disability. What we've set out to do is just eliminate the barriers of time and space as obstacles to exercise so that people can exercise when, where they want to, surrounded by the people that they want to be with.
So, you brought a model to the studios.
Uh-huh.
So I think it's worth describing what it looks like.
For sure.
It's all folded up.
Yep.
It is less than 3 feet high.
It fits in an overhead on an airplane. It folds for easy storage and transport. So when we say it's kind of, think of it like a clamshell, okay, that opens and closes flat. And by that, that's when you put it in the open position is when you use it. It has a large resistance knob at the top so that we could allow people to go from 2 to 70 pounds. They can do it in a recumbent bike position or an upper body ergometer position. And the idea is just be able to fold it and put it out of the way when you don't want to use it, but really to have it there, kind of staring at you, inviting you to exercise more when you're ready to use it.
And it seems, if you look at the diameter when it's all folded up,
Mm-hmm.
I can put my fingers around it.
Yeah.
So, it's, maybe 9 inches in diameter?
Oh, I should know that off the top of my head. It's about, it's about 6 inches when you fold it and when it's laying flat.
Yeah.
So even when it opens up, it's small. But the idea was I want to be able to take it anywhere. We want people to be able to connect exercise to their everyday life at home, at work, on the go, take it to your office, use it while you're watching TV with the family, wherever it is that you want to use it. And so that's why we made it so portable.
And so small.
It's mighty. I call it, it's basically a full-fledged exercise bike in a tiny package, right?
We're going to come back and talk about it.
Okay.
Because there's a lot to talk about. Don't go away. If you miss any of these programs, you'll find Adam's Financial Concepts. The new website is up and running, and you'll find the podcast there. And you'll find this podcast before the end of the week, next week. Don't go away. We're going to be right back after this commercial break. So stay with us.
More About Money coming up with Mike Adams on Business Radio 1300 KKOL. For more information, click on adamsfinancialconcepts.com.
Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Now we return to About Money. There's more information waiting for you at adamsfinancialconcepts.com. Here again is your host, Mike Adams.
I'm here with Michele Mehl of Excy. We've been talking about the exercise machine. It's very compact. It's very small. It's very impressive in that way. I mean, we had a Nordic track at one time. It's big. It's cumbersome. And finding a place to put it, you know. Do you put it in a family room? Do you put it in a den? You know, we're at the point where we have a den and there's no real room for it. And if you put it in a room where nobody is so that you can exercise there, you know, pretty soon you begin to forget where that room is and you forget where the machine is. And in the beginning, for the first 2 weeks, you really dedicated, go in every day and exercise, and then it's every other day, and then it's twice a week, and then it's once a week, and then it's once a month, and then
It has hangers on it.
then, you know, we should just get rid of it.
Yeah. Yep. I'll tell you what, I have a basement full of exercise equipment. I've got a treadmill, I have a bike trainer, I have a pull-up, like place where we can do pull-ups, I have weights. Gosh, I even have rings hanging from the ceiling. Okay. We had everything that you could possibly think of and that you need in a basement, right, to be healthy and exercise. There is a major barrier for a lot of people of making it to the basement. And it's socially isolating, right? I mean, you're looking, even if you have a TV down there, it can be socially isolating, especially if you've been working all day, right? And you want to kind of come home and you want to be with your family. Mm-hmm. And so what we find, and you know, it's if we can help people even just exercise from their own couch while pedaling Excy, it's super quiet, so it doesn't get on anybody's nerves. And you're just sitting there next to your spouse, next to your kid. I mean, I've been on the floor with my dog as my pillow while I'm laying on the floor cycling my legs. And that's just so much more motivating. And it's really hard to capture how that really eliminates the barrier of social isolation. You know, and then if we can get to the point where not only are we surrounded by our friend, you know, our family while we're exercising, but meeting, you know, friends at the park and doing a group exercise and doing a group boot camp together, you know, and then taking it home and then taking it to work. And, you know, there's just something to be said about knocking down the idea that you have to be within four walls, that you have to be at a facility, you know, or even that you have to be in one room in your home, right? Why? Nobody spends, you know, one room in one place all the time. So if we can eliminate that barrier of being socially isolated to a specific room, you know, even being able to still argue with your spouse about what TV show you're going to watch while you have the remote in your hand while exercising, you know, and then landing on one that you don't mind, and then you're still exercising and you got 20 minutes in while you're figuring out what you want to watch on TV. So there's a big win in eliminating that barrier.
So describe what kind of exercise you do. You talked about pedaling, but
Sure.
It's more than pedaling.
It is. So I like to break it down in terms, so we call it a full body exercise bike, okay? There's 3 primary positions that we really try to simulate that you would find in a physical therapy clinic or a gym. And the leading use case is the recumbent exercise bike position. And that allows you to sit in a chair, sit on a couch, however you want, and get yourself in a recumbent bike position. And there's a lot of people who benefit from that, whether they have lower back pain, if they're recovering from hip or knee surgery or a hip replacement. There's so many reasons to use a recumbent exercise bike. And in fact, there are some people who can only do a recumbent exercise bike. It takes the pressure off your spine. It's a wonderful way that we have it. The other thing is an upper body ergometer. And there is this beauty, and usually people who have been on an upper body ergometer, they've only typically been on it because they've hurt themselves and they're at a physical therapy clinic. They've torn their rotator cuff. They have a frozen shoulder. They have, had rotator cuff surgery. Something's going on with the shoulder, or a wrist, and an upper body ergometer is part of their rehab. And what we've done is we've taken that and we've put it in this tiny little device. And it just so you're basically pedaling a bike, but instead of using your feet, you're using your hands. And the beauty in that is that you can actually burn more calories doing an upper body spin than you can in spinning your legs. And so not only in terms of calorie and, motion is lotion in the joint, but also toning, your upper body, and it's not just your arms, but your core, which is so important as we age. So those 3, and then the next position is floor cycling. And there's a host of reasons that you would want to exercise on the floor. There's some general fitness things, but there are some people who, you can do this position in a bed. You lay down and you cycle your legs, kind of in like an old school bicycle crunch. But we have 2 to 70 pounds of resistance. And when you're on the floor and you can do these small motions and you can do large pedaling motions, working through whether it's rehab or just really, cardio. And I like to look at it as double dipping on cardio and strength training at the same time. But there are so many floor-based exercises that we do. And those can come into play with, whether you're able-bodied, or we have people who are paralyzed or amputees, and there are so many reasons to do it on the floor, for everybody. And It also happens to be one of my sons who's 12, one of his favorite ways to use it. It's just comfortable.
So when you say it's 2 to 70 pounds, explain what that means. For
Okay.
a lot of us, we don't understand how much pressure is 2 pounds, how much is 70 pounds, or resistance. 2 pounds or 70 pounds?
It's so strength training, okay? What we like to think is like we are simulating weightlifting, which, the people who gravitate towards using Excy, they are active baby boomers, and, they get it. The idea of not being active after getting an injury or a diagnosis or finding yourself with a disability is just, it's soul crushing, to be honest with you. But the resistance of what it does is it allows you to kind of really force and torque through different ranges of resistance. You can do bicycle, curls to work on your biceps, presses to work on your triceps, leg presses at high resistance. And it's putting your feet on the pedal. But imagine kind of cranking up a really steep hill, and you have to really force your way through the rotation to get through it. When you crank the resistance up that high, that's what you're doing. It's like you're standing on, your bike on a ridiculous hill, just knowing that the only way to get up the hill is to like really force, through the cranking motion. And most of the time, I only will find myself getting at our higher resistance ranges from when we're doing a standing position on it, which is like a unicycle exercise position. Otherwise, it's usually in that 30-pound, 15-pound, 30-pound. But when you're constantly pushing and pulling with 15 pounds, 20 pounds, 30 pounds of resistance, it adds up a lot.
So you actually sold some of these to a sports team. Tell us about that.
We have a Paralympic ski team that has come in, and these are athletes who are skiers who do not have legs, and one doesn't have a leg, and a couple of them, they're also paralyzed from the waist down. We see a lot of spinal cord injuries, and that's one. That's the team, like the only official team, that we have. A lot of other scenarios are Parkinson's disease, diseases where they benefit from high intensity exercise, and Parkinson's disease in particular. Exercise is the only way to prevent the progression of the disease. And the higher the intensity that you go, the better that you'll feel, and the better that we can kind of control, where the disease is going. So seeing some similarities in MS as well. But and we have a couple other scenarios that are pretty interesting too.
It seems like there's a lot of parallels between the financial world and the exercise world.
There's so many parallels between financial planning and health planning. If we break it down in terms of health planning, I like to look at if you just look at exercise as an approach to lose weight, I don't think you'll ever love it, right? But if you look at exercise as a way that it's medicine, right? That it's medicine to help control and prevent disease. I have a genetic pathway of heart disease in my family, and it's really one of the inspirations behind why I started this company. And whenever I'm exercising, I know that if I don't exercise, I don't sleep as well, right? That I don't feel good. And so whenever I kind of like, how am I going to get this dose of medicine today, right? And that's how we like to look at exercise. I mean, you feel better. You feel like you look better. If you're controlling your diabetes, or also just for pain management, can also be hugely important for pain management in joints. So it's the same thing with planning, right? Yeah. If you don't plan for aging and exercise as part of that, things are going to start hurting a lot.
Yes, they will. So how does somebody find out about this machine? Tell us about your website. Tell us about how to contact you.
You go to excy.com, www.excy.com. Again, it's exercise cycling, so excy.com. We are on Facebook. We are on YouTube. We're on Instagram. We're on Twitter. One of the things we haven't talked about is we have a mobile coaching application that coaches you through a lot of the training. And so that's another way, you can download our app. You don't have to have our device to test to use the app and do interval training. So download that for free, and then you can kind of get a feel for what we do. And we try to do a lot of live, broadcasting so that people get ideas of all the different ways that they can use Excy. But our website, at www.excy.com is a good place to start.
And there are different types of machines.
There are. So we have 4 different models. And then we can get into that after the break.
Anyway, so thanks for being on the program. And do check out the website, excy.com. Check it out, and do think about buying one of these machines. They look great. We'll be back right after this break. We're going to be talking about the column in the Seattle Times.
For more information, click on adamsfinancialconcepts.com.
How do you picture retirement? House on the beach, small farm in the country, traveling the world with your spouse. The one thing you don't picture is running out of money. Retirement dreams are shattered all too often by poor investment choices, sending many retirees back to work. If you think the job market is tough now, try entering it after you've retired. Don't run out of money. Start planning now. Call Mike Adams of Adams Financial Concepts today at 206-903-1019 and learn more about how you can create wealth for retirement and, probably most importantly, protect yourself from running out of money. Adams Financial Concepts specializes in creating and maintaining wealth. Call today, 206-903-1019, or log on to adamsfinancialconcepts.com. That's adamsfinancialconcepts.com.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So, I want to finish by talking about a column written by Chuck Jaffe. He's a syndicated columnist. Wrote the column this last Sunday in the Seattle Times, February 4th, 2018, if you want to go read it. He talks about Jack in Massachusetts, a 50-year-old who was recently divorced, has health problems, went through a job change. He met with a financial advisor from a brand name brokerage and got some advice. He didn't do a background check. He didn't get recommendations from family or friends. He hadn't asked for recommendations of the person's clients. He hadn't interviewed other financial advisors. He liked what he heard, so he signed up. And then he had second thoughts. So Chuck Jaffe continued and wrote about what should have happened. A good advisor doesn't fear a background check. That's the first thing he pointed out. You know, I've been in the business for over 30 years, and I've had two incidents. One in 1998, over my objections, my firm settled and paid a client for claims that were not true. Also, there was a time when I was leaving, it came at a time when I was leaving that firm, and some of my clients I had advised to sue the firm. My clients did sue the firm. They did win. You know, that was a person who filed the complaint, had no portfolio loss, but did have one stock that went down. In 2014, I signed a consent order when I had an auditor who spent 4 years in not delivering an audit. In neither case did anyone allege that they lost any money. I'm not embarrassed. I've been in the business for 30 years, and I am fairly aggressive in getting to my clients' financial goals. I'd rather be where they want to be than where things are. Those items, by the way, are on the front page of my website. You can go read about them. They're right there so everybody can see. Check broker check, it's there. You should do a background check just to make sure that there's not things where brokers have lost money for their clients. The second thing he says is to see where their interests lie. He makes the point of fiduciaries. You know, he says only registered investment advisors, certified financial planners, or CPAs. Those are the people who put clients' interest first. And if somebody isn't one of those, ask them to write down in writing that they will act as a fiduciary. Because a fiduciary means you'll make every decision in the client's best interest, and if you don't, you can be sued and you're personally liable for it. You know, when I worked for that big firm, or one of the firms that I work for, I usually do my own research. But in one case, I was at a conference in Houston where there was the bond analyst for that firm who took me through his financial analysis of Boston Chicken. And from his analysis, it looked like almost a slam dunk. Well, the fact is, he made a huge mistake by leaving out a lot of debt that they owed. And Boston Chicken filed for bankruptcy. And I had 22 clients that I recommended that for. The firm had almost 900 financial advisors who had recommended that to clients. And the firm, instead of stepping up and saying, gee, we made a mistake, our financial analyst made a mistake, they said, gee, we were caught by surprise. That surprised us. I didn't like that answer. So I advised my clients. On a Thursday night, we met with an attorney. That attorney, by the way, will be on the program next week to talk about some of these things. I met with my clients. I advised them to sue the firm. And on Friday, I resigned from the firm. You know, that's because the firm put its interest ahead of my clients. I put my clients ahead of the firm. So I believe in that. I believe in being a fiduciary. Fiduciary means that you do everything in the best interest of your clients. By the way, if you do broker check, you won't find anything about Boston Chicken on that. You'll find the other things, but you won't find anything about that because that's where the firm was held at fault. Third thing he said is don't look for someone who overpromises on returns. If the whole thing is to focus on returns, he disagrees with that. And on that, I disagree with that. I believe that it's about achieving your financial goals, which counts. And I believe there's a way to do that. And there's an excessive way to do that. The fourth thing he says, it's somebody who keeps the cost down. He says indexed annuities, variable annuities, non-traded REITs. Those are things that if you hear about those, you should get up and walk out. I agree. I add one other thing to that. I add to partnerships. Jaffe says, if you hear about those things, you know you're being played. And I absolutely agree with that. The only people who do well with annuities, non-traded REITs, or many partnerships are the financial advisors and the company. They may be making 4 to 10% by selling you one of those investments. And most of those investments don't do well for the client. They do only well for the financial advisor and the company. The fifth thing he says is to look at the fees. See how much you're paying and what you get for what you're paying for. Surveys show that the average fee that people pay on an account up to $1 million is 1%. For accounts over $1 million, they pay for less than 1%. If someone's charging more, you have to ask why. I do charge more, and there's a reason why I charge more. And you should be asking me why I charge more. It all goes back to the third point, because I believe that you get paid for the performance you deliver. Performance. Not how well you like me, not how wonderful the financial plan looks, but how well you do financially. The sixth thing, he said, is to explain things in ways you understand. In my business, we often get caught up in talking financialese. We get exposed to a lot of information that's financial information, and we talk, oftentimes, in financial terms, in terms that our clients don't understand, or the people who are prospects don't understand. Jaffe says to spell it out and spell it out clearly. You know, we're going to put all this into an e-letter later in the week, so if you want to receive the e-letter, you can go to our website and sign up for that. We want to make all of this available. If you miss any of these programs, go to our website, adamsfinancialconcepts.com, and check us out. It's all right there. The philosophy, the strategy on what we do, it's there. We want to be transparent and straightforward. We believe we do an exceptional job for our clients. I don't very often talk about what we do. Most of this program is meant to be educational. It just happened. I read the column. I like what I had to say. And so it's here. Join us next week. We've got more to talk about. We'll wrap up the what's wrong with financial planning and maybe introduce another series. We'll see what's coming up. Have a great weekend, a great week, and I will be on a different station soon. We'll be on KFLE. You should get the information. KKOL will be shutting down. So find us, 1590 KFLE. That's coming soon. Until then, have a very good week, a good weekend, and I will be back next week.
It's going on different show.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you want Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared on the preceding program was for educational purposes only. Any investment advice given may not be suitable for all investors. Join us again for more About Money with Mike Adams here on Business Radio 1300 KKOL.
The preceding program was sponsored by Adams Financial Concepts. Creating and maintaining wealth has been the specialty of Adams Financial Concepts for over 20 years. Every portfolio managed by Adams Financial Concepts is customized to fit each particular client's objectives and risk tolerance. The client's interest always comes first in portfolio decisions. Call Mike Adams today at 206-903-1019 or log on to adamsfinancialconcepts.com to check out their AFC performance. They welcome your review. That's adamsfinancialconcepts.com.
Life is full of second chances, so we want to make sure you know your second chance to catch Phil's gang is coming.
The following program sponsored by Adam.